Right friends, welcome back to Banking Awareness. This is the 25th lecture and we are discussing about capital market. We have already discussed government securities market, industrial securities market like shares, debentures we have already discussed, and development finance institutions we are discussing. And in the 24th lecture we discussed about various general development finance institutions, and in this connection I would like to tell you a brief. Subsequent to independence, banks were in private sector, and at that time the capital base of banks was less. At that time it was thought that there was a necessity of general development finance institutions. Accordingly, IFCI, ICICI, IDBI were established, and later on, after 1990s, the concept of universal banking came into existence. With the concept of universal banking, the development finance institutions like IDBI, ICICI and IFCI lost their relevance, and now there is change in the thought process of the government. Government wants to separate this project finance from the banking system because of high non-performing assets in the banking system. So now the concept is taking shape once again with regard to this separating project finance from the banking system. But for the past 10-15 years, banks are giving finance to infrastructure sector, various development projects by forming as group of banks, or you can say syndicate loans. That means banks are coming together to give loans, that is a syndicate loan or multiple banking accounts. For the past 10-15 years, banks are coming forward and they are acting as a group to give loans to projects, that is known as multiple banking accounts or syndicate loans. So nowadays banks are giving project finance by coming together, and now there is a conceptual change. Now the government wants to separate this from the banking system. This is about general development finance institutions, but when you look at the sectoral development finance institutions, there is still relevance of these sectoral development finance institutions because they are behind developing certain sectors of the economy. If you look at the NABARD, it was established primarily with a view to develop agriculture and rural development. If you look at the SIDB, it is established with the motto of developing MSMEs. If you look at the Mudra Bank, it is established primarily with a view to develop micro and small enterprises. If you look at NHB, it is established with a view to develop housing sector in the country, and similarly Power Finance Corporation, that is with a view to arrange low cost finance for power sector development. Then Rural Electrification Corporation, that is for developing rural electrification in the country. IRFC, that is for arranging low cost finance to railways for procurement of wagons and other assets. Exim Bank, that is established with a view to give impetus to exports in the country. So like this, there is a need for these sectoral development institutions, and we are going to discuss various sectoral development institutions because these have got their own relevance nowadays. Right friends, so if you look at the development finance institutions, by leaving NABARD and NHB, these are very important development finance institutions, NABARD and NHB. We have discussed in previous classes, NABARD is basically for arranging low cost finance, or you can say refinance to agriculture and rural development. So you may ask, what is refinance? Let us assume State Bank of India is granting loans to agriculture and rural development, and to the extent SBI is granting loans, this NABARD will refinance. Similarly, if you look at Mudra Bank will refinance to State Bank of India to the extent State Bank of India is giving finance to micro and small enterprises. So, this is the meaning of refinance, and most of these sectoral finance institutions are into refinance. Friends, let us look at the SIDBI, because I am not discussing NABARD and NHB. If you look at the SIDBI, this is established basically to develop MSME sector. It is the Small Industries Development Bank of India, established in the year 1990, initially as a fully owned subsidiary of IDBI, but the present shareholding is diversified. Headquarters is in Lucknow. It is the principal financial institution for promotion, financing and development of MSME sector. If you look at the Rural Electrification Corporation, this is Navaratna CPSE. CPSE is Central Public Sector Enterprise, and there is a classification of Maharatna, Navaratna, Mini Ratna, like that, and public sector enterprises are classified based on their turnover, and this Rural Electrification Corporation is a Navaratna Central Public Sector Enterprise, established in 1969, basically to arrange low cost finance and promote rural electrification projects across the country. Mainly it issues tax free bonds to collect funds at lesser interest rate. Then Power Finance Corporation, it is also Navaratna Central Public Sector Enterprise. This was established in the year 1986 with headquarters in New Delhi. The main purpose is mobilization of funds through taxable bonds, non-taxable bonds, term loans from various financial institutions, and they will arrange low cost finance for power generation projects in the country. If you look at NSIC, this is National Small Industries Corporation. This was established in 1955 as Central Public Sector Enterprise, headquarters in New Delhi. It facilitates the growth of MSMEs. SIDBI arranges finance to MSMEs, or you can say refinance MSMEs. Then NSIC, this basically promotes the growth of small enterprises by modernization, upgradation of technology. When you look at modernization and upgradation of technology, the institution which is relevant is National Small Industries Corporation. And if you look at refinance, that is the SIDBI. Then IRFC is Indian Railway Finance Corporation. It is the financing arm of Ministry of Railways, headquarters in New Delhi, and it taps funds through tax-free bonds or foreign currency loans at low interest, basically to finance Indian Railways to purchase wagons or locomotives or other assets. Another important organization is Exim Bank. Exim Bank is Export-Import Bank of India, established in 1982 under Export-Import Bank of India Act of 1981 by Government of India, with the Mumbai headquarters. Basically, it promotes foreign trade. It arranges loans for facilitating, promoting foreign trade. For that purpose, this Exim Bank is established. If you look at another institution, that is ECGC, that is Export Credit Guarantee Corporation of India Limited. Basically, it gives insurance against the export credit risks. You can call it as insurance organization for exports. So, ECGC is Export Credit Guarantee Corporation of India, and it was established subsequent to TC Kapoor committee recommendations, basically to take care of risks in export sector. This is primarily for insurance against export credit risks and trade related services. So, if someone asks you the organization which takes care of insurance needs of export sector is ECGC, or Export Credit Guarantee Corporation of India. Another development financial institution is the TFCI, that is Tourism Finance Corporation of India Limited. This was established based on UNES committee recommendations and started functioning from 1989. Basically, it gives financial assistance to enterprises of tourism related projects. The last one is Mudra Bank, which was recently established, and certain things you should not forget. Basically, SIDBI is established as a refinance agency for MSMEs. NSIC is established for technology upgradation of MSMEs. Mudra Bank was recently established. It is Micro Units Development and Refinance Agency. The name itself suggests it gives refinance to micro units. It arranges low cost finance to banks and other intermediaries, and in turn they will pass on the benefit to the micro and small enterprises. So, this is responsible for developing and refinancing of micro and small enterprises. This partners with various commercial banks, microfinance institutions, other financial institutions to finance micro and small enterprises. It is a refinance agency, you can say. Headquarters is in Mumbai, and at present it is working as a non-banking financial company, and it is the subsidiary of SIDBI. Exact framework of Mudra is yet to be finalized as a stopgap measure or as a temporary measure. It is working as non-banking financial company and the subsidiary of SIDBI. Right friends, we have discussed various sectoral development finance institutions. These are very much relevant today, and they are for development of various sectors, and they are categorized as sectoral development finance institutions. Friends, with this we completed government dated securities, industrial securities like shares and debentures. We completed development financial institutions, both general as well as sectoral, and the last one is financial intermediaries. Most important is they will act as intermediaries for arranging long-term finance, or you can say they will act as facilitators. First one is investment banks. All of you are familiar with Goldman Sachs, Morgan Stanley, JP Morgan Chase, Bank of America Merrill Lynch. These are all investment banks. Top world-class investment banks are based in United States of America. Most of them are based in United States of America. In our country also we got investment banks, but they have not earned that much name. If top class merger and acquisition is required, then that will be entrusted to world class investment banks even now also, because investment banks in our country have not evolved up to the mark. So, world class investment banks are Goldman Sachs, then Morgan Stanley, JP Morgan Chase. These are all examples of world class investment banks. What is the main purpose of investment banks? Main purpose of investment banks is debt and equity underwriting of corporates. If Reliance Industries want to issue shares for 10,000 crores of rupees, if Reliance Industries wants to issue debentures for rupees 10,000 crores, then the formalities, what should be the pricing, what are the modalities, this is written by investment banks. So, investment banks basically undertake debt and equity underwriting of corporates. Second is it gives banking services to companies and financial institutions. Then it gives strategic advice with regard to mergers and acquisitions. If one telecom company wants to merge with another telecom company, that comes under the category of mergers and acquisitions. In such cases, advice is taken from investment banks. And it also manages portfolio management of rich persons. It manages the portfolio, or you can say it manages the investment needs of rich individuals or high net worth individuals. So, investment banks is the most important intermediary in the financial market. And if you look at merchant banks, in some countries investment banks are known as merchant banks also. We have discussed about investment banks. And merchant banks, there is a slight difference. When it involves overseas operations, normally it is known as merchant bank. If you are dealing with international financial activities, and if you are looking at foreign corporate investment and foreign real estate investment, then these merchant banks will come into picture. But nowadays, the dividing line between investment banks and merchant banks has gone, and they are used interchangeably in several countries. But there is a slight difference between investment banks and merchant banks. And if you look at mutual funds mutual funds is nothing but they will pool up money from small investors like you and me. They will pool up money from small investors like you and me. And if you want examples, please look into this: Reliance Mutual Fund, UTI Mutual Fund, ICICI Prudential, HDFC Mutual Fund. These are all examples of mutual funds. And they will pool up money like from you and me, and they use their brain to invest in various companies by pooling up money from several investors. So that is a mutual fund. Here risk is diversified, risk is less because they are investing by using their brain in several companies. So this is a mutual fund, and these are all examples of mutual funds. Then another financial intermediary is leasing companies. If some petroleum exploration has to take place, then it involves huge machinery of rigs. Some companies arrange leasing. So leasing is basically the agreement or contract between two parties for hiring a specific asset. And some of the leasing companies examples I have given here, that means here lessor retains the ownership and lessee will use it by paying something. For heavy machinery, these leasing companies will give that machinery on lease, right? So leasing companies are also financial intermediaries. And the last one is venture capital. Venture capital is money provided by investors to start up firms and small businesses. If somebody wants to establish a company, and for that company, for startup company, for budding company, somebody arranges money, that is a venture capital. But this venture capital financing has also not taken roots properly in our country, and almost 80 to 90% of venture capital is given by foreign firms even nowadays. So venture capital is the money provided by investors to start up firms or budding firms with perceived high growth potential. So we have discussed about these financial intermediaries which facilitate long-term finance like investment banks, mutual funds, leasing companies, venture capital. So most of the things we discussed under this capital market, not only government securities market, industrial securities market, development finance institutions, both general as well as sectoral, and financial intermediaries we have discussed. So this ends Indian financial market. I think this is sufficient for you at this juncture, and with this let us conclude the 25th lecture. Please do join for 26th module. We are going to discuss some other topic. Right friends, have a nice day. Thank you.